for the first time in quite some time, the market actually retested the 200-day moving average. We haven't been down to the 200-day moving average in a very, very long time. We got close to the 200-day moving average last July. We didn't even touch it back then, but now we've actually tested the 200-day moving average yesterday. Here's what you need to know before the bell this morning. So as I was saying, yesterday, the markets are very bearish, very oversold. We're down 6% from the peak. This is the time where you should start to look for an opportunity to invest in the markets. Now, does that mean the markets are absolutely in the position where they are going to go just up from here, right? Don't know that. The problem with finding a market bottom is that it takes time to work that out, right? Because you need markets to kind of spend some time consolidating a bit and looking for an opportunity to start to rebound from very oversold levels. And this is kind of where we are at the moment, is that for the first time in quite some time, the market actually retested the 200-day moving average. We haven't been down to the 200-day moving average in a very, very long time. We got close to the 200-day moving average last July. We haven't even touched it. We didn't even touch it back then, but now we've actually tested the 200-day moving average yesterday. So this is something that hasn't happened in the markets very often as of late, but we did successfully test that level at the 200-day moving average, bounced off of that. We do have a cluster of resistance sitting up right around 5,900 on the S&P. That's the 20-day, the 100-day, the 50-day. They're all clustering right there. So there is going to be some very tough kind of ability for the markets to rise above that just at the initial run. It could certainly happen, but most likely we're going to be kind of trapped in this consolidation range here for a bit. But it certainly doesn't mean that we can't see markets begin to start to recover here a bit and start to see a little bit more positive price action. Again, as I was talking about, previously, this oversold condition in the markets has now pushed this MACD indicator to some of the lowest levels that we've actually seen in quite some time. So we've got a very, very oversold condition in terms of momentum. We have a very oversold condition in terms of relative strength as well. And again, previous conditions like this, where you've had a very oversold level that's been bought, that is typically kind of lined up with a temporary market bottom. This kind of goes back in history. So again, I'm not saying this is the next great buying opportunity for the next major bull market that's going to take off from here. But this is probably getting close to a level where you're going to get a reflexive rally in this market and then use that as an opportunity to rebalance risk in your portfolio. If you're really worried about this market that's could potentially go down 20%, right? We could have that bigger crash that everybody's been hoping for the last couple of years. That's not going to happen all at once. You're still going to get an opportunity. So when this market bounces and we get back up towards that 5,900 level, take a little bit of money off the table, right? There's an opportunity here for a tradable rally. That's all it is, right, at this point. Now, if that matures into a more stable, longer-term rally where markets kind of get their feet back under them and we begin to rally again, set it, and we get above these moving averages, set a new high, well, then that's okay, right? You've still got exposure to the markets. But again, it's just, you have to manage your risk levels, manage your kind of exposures where you want them. But again, we have just started to reach such negative levels here in terms of sentiment, positioning, momentum, that those are generally a decent opportunity here for again, a reflexive rebound in the markets that you can then either take advantage of or use to rebalance and reduce risk in your portfolios. Now, we're not just seeing it there. As we kind of talked about the other day, part of this decline has also been a decline in the dollar. We've seen we talked about this previously, is that the dollar had gotten very, very overbought, was due for a correction. We're down to the 200-day moving average on the dollar as well. So part of this pressure has been outflows from the dollar. We had a lot of foreign inflows coming into U.S. markets over the last year. That was a function of this rising dollar. We've had a reversal of that, so that's part of what's been weighing on the asset markets as of late. That's part of this decline that's going on. Again, we're very, very oversold in the dollar now, so if we start to see a counter trend bounce in the dollar, that should also feed back into money flows coming back into and from foreign inflows back into U.S. assets. And then on the other side of this, bonds have now gotten extremely overbought. Again, great rally here in bonds. They've been an awesome hedge to portfolios this year. But we're flirting right now with a very overbought condition. They ran right into the 200-day moving average yesterday, sold off a bit here. Would not be surprised with such an overbought condition in bonds short term that we get a pullback towards, the $90 level on TLT as an example. That would probably put the 10-year Treasury rate somewhere probably around 4.3%, maybe 4.4 on a rally. But actually, interest rates did take out the 200-day moving average yesterday, rallied back to that. So we'll see. So at 4.2, that was around the 200-day moving average for interest rates. So we've had a first really kind of initial break of support for 10-year Treasury bonds. They are, again, interest rates are very, very overbought here, just like bond prices. So again, expect a little bit of a reset here, but if we continue to kind of build a downward trend in rates, that's going to start to align with the weaker outlook that we're seeing right now for economic activity, as well as lower rates of inflation, which are all starting to kind of manifest themselves. We've been talking about that really since last year, as a lot of this data outlook really isn't there and supportive enough for a continued rise in inflation. So we're starting to see some of that reversal now. Okay, that's what you need to know before the bell this morning.